All right, for those considering investing in stocks, now is always the best time to do so. But what happens when a company splits their stock? Here to talk all about how stock splits affect investors is President and CEO of Wilsey Asset Management, Brent Wilsey. Brent, good morning. Nice to see you in person.
It's good to be here in person, yes.
You know, when you think of stock splitting, I think of years ago, as somebody said, so-and-so bought a stock and it split and they made like all kinds of money. Is that how it works, or how does it work? Why does it split?
Yeah, not really, and this is a big fallacy that they have on Wall Street. Unfortunately, investors fall for it. So let's talk about what it is. A stock split is, normally it's a 2-for-1 split. You had 100 shares and I have 200 shares. Oh, how great that is, I got more shares. So people really like it, but it does nothing at all financially. What happens when you split the stock from, we'll say 100 to 50? Well, you also split the earnings. If the earnings were 10, now they're 5. Everything, the sales were $1 billion, now they're $500 million. So everything on the financial split, so there's no financial gain at all. And who's talking about splitting right now? That's the big thing, is you got 3 big companies, Google, Amazon, and Tesla, talking about splitting their stocks. Now, these are big splits. Normally, a split is maybe 2-for-1. They're talking, Amazon and Google, 20-for-1. So you're going to have a lot of shares. Like, wow, how great this is going to be.
Is that to bring the price down so more people can afford the stock?
It's to bring the price down so more people can afford it. But that's what they think it is. But again, you're not getting anything for that, because a stock, again, if it's $2,000, it's going to go from $2,000 down to a 20-for-1 would be what, $100 is what it would be. Right. Now, the thing is that I'm not sure if Tesla's going to do it, because we know that Elon Musk is working so hard on Twitter and so forth. I may direct them. Now, the board of directors who suggests the stock split and gets that going, but we'll still see what's happening. Another problem, too, these stocks are falling dramatically. I mean, on Friday, Amazon fell $400. Now, this is something that could be beneficial for them, because why would a company do that? Well, if you went down $400 on Friday, you split the stock 20-for-1, well, now you went down, what, $10, $20, right? Is my math correct?
I don't know.
Yeah.
You're the math guy, man.
Well, $400, because a 10-for-1 would be 40, so yeah, for a 20-for-1 would be 20. So yeah, so now the drop is 20. Doesn't look as bad as a $400 drop in the stock.
Right.
So these are things that people really kind of get taken away from, and I never recommend buying a stock because it's splitting. You think you get that bump, but it's really not there.
What is a reverse split?
A reverse split is where the company does the opposite. General Electric did this. General Electric, their stock was so low, they want to get listed on the exchange, so they reverse the split. So if they had 10 shares, they did a 10-for-1 stock split, the stock would go for 100. So now you have a higher stock price, but less shares. So it's the opposite of a normal split.
So does an investor benefit from a split? Not a reverse split, but a split?
The split, that they do not. And the big thing is, why a split is done is that what happens right now, like at $2,000, $2,500, you're not going to be listed in the index, because you'd be too much of a concentration on the Dow or another smaller index. So by splitting that stock, they can go into other indexes. Also, too, companies many times issue for compensation their stock to their employees. Well, many times it's not a $2,000 bonus you want to give somebody, but maybe you want to give them 10 shares. So therefore, you split the stock. You can now give your stock more for compensation to your employees that you couldn't do before. Now, I do want to point out, on normal exchanges now, you can actually get fractional shares, but the company can't do fractional shares. They can only do for compensation the normal shares. And you do get that initial stock bump when they announce it, which happened. But again, if you bought when they announced it, you're down probably 15, maybe 20% now from when they announced that.
Does a company necessarily disclose the fact that their stock is splitting, or is it required by law, or how does that work?
Well, yeah, they want to disclose it. They want to talk about it, because again, oh yeah, this is going to be great and so forth. And they know, and I've said this for 30 years, stock split does nothing. Warren Buffett said it. I mean, people in the industry know it does nothing, but there's still people out there that think, oh, well, this is good because now I get, more shares. And that's not the case. It just is not good. And there is some benefit to it. I mean, some numbers over the last 10 years, there's been about 20 splits per year. That does happen. The 97 to 2000 tech bubble jumped to 6,500. That shows you the craziness, how it brings this stuff on. And the problem is that the numbers look like they're pretty good, because since 1980, we've had stock splits. They beat the index by 16%. So you think they're going to do good. but 30% of those did not do well. The thing is, you can't buy 20 stocks per year to split. It's not going to work out. You're going to run out of cash eventually. So we say stay away from the stock splits. It's not going to benefit you. It sounds pretty good. Look at the valuations. Look at the fundamentals. What business you're buying. If they split, great. If not, don't worry about it.
Well, okay, good to know. You have any seminars coming up?
We do not. We've been so busy, so we're telling people go to our website, smartinvesting2000.com. A lot of great information there. They can sign up for our newsletter, listen to our podcast there as well. So there's many things on that website to really help educate people on investing.
Great information. Brent Wilsey, Wilsey Asset Management. Thanks, Brent.
Thank you.
As always.